Good afternoon and welcome to another edition of Money Matters TV. My name is Dan White. I am the host of your show today, and I'm also the president of Daniel White and Associates. We are a retirement planning firm. We're headquartered in Glen Mills, Pennsylvania, and we have satellite offices in Middletown, Delaware, and we just opened a third office down in Lewis, Delaware, down to Delaware Beaches. And we focus our practice on pre-retirees and retirees. I mean, 55 to 75 years old is our target market, and we do a lot of seminar marketing. We're on the radio, that type of thing, and it's kind of interesting. You know, the biggest concern that we're hearing from clients, I mean, all the people that we see on a daily basis, is that they're mainly that it's I'm going to run out of money. You know, that's why people are afraid to spend their money in retirement. Because they're afraid they're going to run out. You know, they're worried about, maybe they got beat up a little bit in the Great Recessions. If, little older folks can relate back to the dot-com bubble. And, it's been proven that if you retire at one of those wrong times and you're drawing a lot of money out of your portfolio at the wrong time, it doesn't bode well. The sequence of return risk is pretty severe, and you're not in a position to go back to work. So the way we solve that, we tend to use kind of a bucket strategy. We use an income bucket, which we feel has to be safer. It has to be safe money because that's where you're going to be drawing your retirement income from. And then you have a growth bucket as well. And the growth bucket is the inflation hedge. You're not taking you're taking risk with the growth bucket, but if you've got the income locked down and you have enough income coming in, you shouldn't have to touch the growth bucket, and that can grow unimpeded. So that's how we kind of deal with retirement income and some of the risk associated with it. It's a lot different today than it was 30, 40 years ago. People today no longer have pensions. Social Security is a little shaky. That's the only guaranteed income source people have. And then it's their savings, and they have to rely on their savings. And we've all heard about the 4% rule. You can withdraw 4% from your portfolio, inflation adjusted, and there's back in the day, there was about a 95% chance you would make it to 90 or 95 years old. Well, now that's kind of been ticked down with some of the downturns. It might be in the 3% or so forth. So people are concerned. They're worried about running out of money in retirement. And then the other thing that comes into play that we hear a lot is, everybody wants to know where the stock market's going. What's it going to do? And nobody has a crystal ball. But I'm in the belief that, back in November, if you recall, August, September, and October of last year, the market hit about a 10% drop, what would be considered a garden variety correction. And everybody was kind of worried, here it comes, we're going to get smacked here. And then it turned around in November. I think the Fed had a meeting in November, and Chairman Powell was predicting 3 rate cuts this year, and some prognosticators turned that into 6, and the market took off. I mean, it took off. It's probably up 25% since November. And then we hit a little blip about 2 weeks ago. But I think that's all been predicated on the Fed cutting interest rates. Everybody wants to go back to zero interest rates, where life was good. Unfortunately, inflation is not cooperating. We got a couple inflation reports in March and April, and they were heading in the wrong direction. Inflation was going up instead of down. So that kind of pushed back the rate cuts, pushed them back from, originally they were talking March, and then they moved it to June. And now we're worried whether we're going to get any rate cuts at all. And maybe there's a rate hike on the horizon. And I'm sure that the market has not factored in a rate hike. So it all depends. And then last week we got some good news because the jobs report came in, and unemployment went up. We didn't add as many jobs as the Fed predicted we would. And again, bad news is good news. They took that as a good sign. Oh, unemployment's going up. That means our rate hikes are working, and we might be able to cut rates a little later this year. And that's when everybody kind of jumped on the bandwagon. The market shot up a little bit. So that's kind of where we're at today with the markets and also, with people running out of money. So I'm joined today. I'm pleasantly joined today by Steve Check. Steve is the CEO of Check Capital Management out in Orange County, California. Steve, welcome to the show.
Thank you, Dan. I'm happy to be here.
You probably have, well, we're having pretty good weather here today, 80 degrees in Pennsylvania, but you probably get used to that every day out there.
Our typical weather is 75, plus or minus 2 degrees.
Yeah, it's nothing wrong with that. So, so Steve, you've been in business how long?
37 years, believe it or not.
Wow, that's the same as me. I've been doing this since 1987 myself. So, a couple old timers here. We've got a lot under our belts here. Before we get into talking about what you do, Steve, with your firm and how you manage clients' money and so forth, we did have a question. A question came in from our listeners, from Robert Morris up in Boston. He said, in the stock market, are we at an all-time high? And if so, how should we plan for a correction? I'll take a stab at that first, Steve, and then I'll get your input. But I mean, we are probably about 1 or 2% off the all-time high. I mean, we're very high. The stock market is valued pretty expensively right now. If you are concerned about that, one avenue people have today, which we didn't have for years, is you can actually earn interest at the bank. We've got banks paying, north of 5%, 5.25%. You can get that in a money market account at Schwab. You can get it at the local bank, and it's completely liquid. I mean, the goal used to be, you save up $1 million and you're getting 5%. You got 50 grand and you're not touching your principal. Well, after the Great Recession hit, they took interest rates to zero for a better part of 15 years, and that was no longer the case. And I think people went further and further out on the yield curve. They were taking more risks just to get any type of return. The good news today, you can get 5% in your local bank. And I think it really boils down to, how old are you and when are you going to need the money? I mean, if you don't need the money, if you're 35 years old and you're saving for retirement, I wouldn't worry about a correction over 30 years. The market will go up. But if you're near retirement and, you're going to start drawing on this money quickly, I think it has to be moved to a safer position. And as I said earlier, our firm kind of sets up an income bucket and a growth bucket. And the income bucket doesn't matter what the market does. You're still going to get the income. And then the growth bucket, if we're not touching it, we can kind of let that grow. Steve, what are your thoughts on that? If we're near the all-time high and one of your clients, I mean, how are you preparing them for a correction?
Yeah, first of all, timing the market is, in my opinion, impossible. So you should really set up your overall portfolio. So that's just not part of what you have to do. And Dan, you do sound very familiar. The fact that you're in business the same amount of time as I've been, but also a bucket approach. We take a bucket approach ourselves too, maybe a little bit different. We call it a spending bucket and a growth bucket, as opposed to your term income bucket and a growth bucket. But we like to set aside for our clients the next 3 to 5 years of withdrawal money in the spending bucket, and then the remaining money goes in the growth bucket to be rewarded by what would normally be stock market investments that do outperform over that type of time frame. Sure. But a 10% correction in the market happens, as like once every about 2 years on average. So really, you should be planning for that versus being worried about it when it does happen.
Yeah, and I guess the issue as well is, and I don't know how long I've been saying it. So when does the national debt become an issue? I mean, we're north of 34 trillion. We're going to be over 35 trillion. Where do you see that becoming an issue?
Well, the debt is in our own currency. So if we had to pay it in some other currency, that might be another story. But in our case, the U.S. dollar is the world reserve, and we can issue more dollars when we want to. And you would think there will be inflation, and there is inflation. As we've seen now, in the last couple of years, there is real inflation. But it's a concern, but we have a very resilient system. And again, if you are concerned about that, again, going to cash isn't the right call. I don't think it's owning a business that is an inflation hedge.
Yeah, and I think you're true. I mean, if you're worried about a correction, it really boils down to having a plan in place, and then following that plan. And if you're going to have a 10% or correction, if you're following your plan and you've set it up properly, it's not going to be an issue. So. If any of the listeners out there want to send in a question, here's how you can send in a question to Money Matters.
You can have your questions answered on Money Matters. Please go to our website, money-matterstv.com, On our homepage, click on the banner on the right that says Send Us Your Questions. While you're on our website, you can find information about our host and guests, as well as show notes and links about this show and past shows. Money Matters is also available as a podcast on iTunes and Stitcher, so you can listen to Money Matters while you're on the go. That website address, again, is money, MONEY, -matters, MATTERS, TV.com.
All right. So, like I said, it's my pleasure to have Steve on the show today. And I'm kind of excited because, as we just found out, we're in the business the same amount of time. We do things our way. He probably does things a little differently. But just to kick things off, Steve, I know you touched on this, but what is the investment philosophy and approach of Check Capital? How do you try to do it?
Well, first of all, we manage about $1.9 billion for about 1,100 clients. Coming from the old school, back 37 years ago, we actually bought individual stocks and sold individual stocks and invested in the market that way. And that's still what we do here at Check Capital Management. So we take a relatively focused approach. We try to find maybe 15 really good companies trading at really good prices, and we're generally quite long-term owners. A lot of my cue comes from the example of Warren Buffett. And Berkshire Hathaway's actually been our largest holding for probably 25 years. I've attended the annual meetings for 28 years in a row, if you want to count the COVID years where we watched them online. But I just got back from that here this weekend, and it's really like going back to, again, back home and hearing about the rational way to invest, which is, when you own stock, you're a part owner in a business, and you want to get good businesses at good prices.
Yeah, it must have been a little different this year without Charlie Munger there.
It was different. It started out with kind of a reflection video of Charlie and his life, and he was always sort of there in the background. And even in answering the first question, where Warren will turn to his, I guess it would be to his left, and say, "Charlie, do you have anything to add?" He actually said, "Charlie, do you have anything to add?"
Right.
Greg Abel. So.
Yeah, I get a newsletter from Whitney Tilson, and I know he goes to the annual meeting every year, and he had mentioned that Warren had Charlie, and he's like, Charlie's not here anymore. So,
Yeah.
But yeah, Berkshire Hathaway is a great model to follow, and I know Warren has said in the past, it's not that they're great investors; they just try to avoid stupid mistakes, which is what most people do, but. Can you describe a little bit about the types of investment strategies or products that your firm offers to clients?
Well, we have three that would be kind of considered in the growth area, and the primary one, where over $1 billion of the $1.9 billion we manage, is in the stocks, as I talked about. A relatively focused portfolio, 12 to 15 stocks would be typical, but for more aggressive people, we have found a way to invest in Berkshire Hathaway options and kind of leverage, if you will, Berkshire's steady growth into higher returns. And I won't mention the returns here on the air, but anyone could go to our website and kind of find a fact sheet on what we do. And then for people that want something that's lower risk, especially as you mentioned, over the last 15 years where interest rates were very low, we found a way to, you could buy Berkshire Hathaway stock and actually sell a covered call against the stock and we came up with anyway returns that were a fair amount better than fixed income type of alternatives. So those are our three primary products, and then we'll ladder up bonds to kind of cover that as you call the income bucket, or we'll call the spending bucket.
Yeah, I was kind of curious how you did that because, for 15 years, like you say, there was no yield at all. And it was hard to, people didn't want to have 100% in the market, but at the same point in time, you're killing the portfolio when you're only getting 1% to 2% on the fixed income side. Well, how does your company kind of assess and select the investment opportunities for the portfolio? So is there any type of screening process that you go through when you're making stock selections?
Yeah, and we recognize, first of all, as we've kind of been talking about already, that the market is volatile, and use that volatility to your advantage, not disadvantage. So if the market does sell off, that's where you want to be looking for bargains. But we've really got it down to maybe around 150 companies that we think are of the quality that if we could buy them at the right price, we would. And what we're really looking for are durable growth companies. managed by managers that really have the shareholders in mind. And you'll see that often through the capital allocation decisions that the management makes, such as buying back their stock when it's cheap. That's a very shareholder-friendly type of thing to do, as opposed to just building an empire and buying another company for them to be managing a bigger entity. So we really we take it down from like I said, 150 good quality companies, and we're following them all the time. And if we follow an average company, we probably get a chance to buy it once every 5 or 10 years. But when we do buy, we like to buy in force. We don't trade very often. We probably only buy 2 or 3 companies a year, or 3 or 4 stocks a year. And we usually hold them around 7 years is what we're finding is our typical holding period. So relatively tax efficient in the sense that we do take long-term capital gains when we do take profits. And at the same time, we let some compounding work for us.
Yeah, so I'm going to go off the grid maybe a little bit here, Steve. The rage all last year, we heard about the Magnificent Seven and AI. And if you're not part of AI, you're missing the boat. And all the semiconductor stocks that were going to the moon. I'm sure they would not pass your test as far as being appropriate for your client base.
Well, first of all, there's always a hot area of the market. I've seen hot areas of the market for the last, 35 years. And generally speaking, you're right. That's not where you want to go, because when they're hot, they're usually not inexpensive. Interestingly, we have owned Alphabet or Google over the last several years. It wasn't overpriced from let's say a value investor's point of view, and that might be termed as buying something at a price to earnings ratio of 15 or 20. But when those stocks start trading at price to earnings ratios of 30 or 40 because they become very popular, no, that's not something I'd be interested in. And I think even you're seeing Warren Buffett here with Apple. Apple is by far Berkshire's largest stock position. But he took on that position maybe 7 or 8 years ago when the stock was trading at around a PE of 15. And now that it trades at a PE of 25 or 30, he's been trimming the position over the last couple of quarters.
Yeah, you stole some of my thunder. I was going to bring up Apple because I knew Berkshire had sold some of that. So I guess from what I'm hearing, you're not buying NVIDIA, you're not buying micro semicomputers, that type of thing, because the valuations and the multiples are just too high at this point.
That's correct. We are not buying them. You have to make it pencil out. You have to say to yourself, if the stock trades at a kind of a more normal price earnings ratio, say in 5 or 10 years, what do the earnings have to do to justify, let's say, today's price? And a lot of times those kind of things do not pencil out. Though we have been surprised. I mean, the big tech over the last 10 years has I think done better than any group of big companies in history, and it has surprised a lot of us.
Yeah, and last year was kind of an outlier in the sense that when you talk about the Magnificent Seven, the S&P was up 24% last year, but a lot of that was the big companies. If you took away those 7 stocks, I think the S&P was for the most part flat last year.
Yeah, no question. They have been driving the market here for a while, and now the year before they didn't. They went the other way, so maybe last year was a bit of a rebound, but nonetheless, over the last 5 years, they certainly have. And if you look at the NASDAQ, it's done quite a bit better than the S&P, let's say, over the last 20 years. And that's because the NASDAQ has those big tech companies as a heavy weighting in their index.
Yeah. So again, talking about your philosophy at your company and your allegiance to kind of Berkshire Hathaway, would you consider the investing you do for your clients, would you consider yourself a growth investor or more geared toward more of a value investor?
Well, we want the best growth we can get, but first and foremost, though, we really do put a big weighting on valuation, and of course, what a company is worth. A lot to what it is worth is based on the growth, but not the growth over the next 1 or 2 years, but the growth over the next 10 or 15 years. So we have a hard time really thinking that can confidently predict 10 or 15 year type out numbers in terms of earnings. So most times you put us in the value camp where we're saying, hey, we want this company to be cheap based on what we think the company's going to earn over the next, say, 3 to 4 to 5 years.
So basically, you from what I'm hearing then, Steve, is you kind of have this 150 stocks on the radar, a watch list, if you will. And then as you're checking them and the valuations come down in a range that you feel comfortable with, that's when you begin to make your selections. Is that what I'm hearing?
Yeah, you're hearing it exactly right. I mean, and to get on that list of 150, the company is going to have to have been around for a while, like say 15, 20, 30 years, and have been steady, market leading performers over that kind of period of time. We believe winners often stay winners, and success, follows success. And but again, there's a right price to pay for that success, and that's what we were talking about in terms of the valuation.
Yeah, I've looked at some of Berkshire's stuff over the years. I mean, he's a big Coca-Cola fan and Hershey's. And again, it all depends on the price you buy in at, whether it's going to be a good investment or a bad investment. Even great companies, if you buy them at too expensive, it's not going to pan out for you. So, I mean, I've read these stories about Buffett time and time again. But what would you say sets your firm apart, Steve, from other investment firms in terms of your approach to wealth management and investment strategies? Why Check Capital Management over somebody else?
Well, we're a very independent firm. We're a registered investment advisor, registered with the Securities and Exchange Commission, but we're not working for any bigger place that's looking for us to sell a certain product or anything of the sort. One thing that I guess that really does set us apart is our fee schedule for qualified clients, and the SEC has a definition of what qualified clients are. But qualified clients pay us a management fee equal to 10% of their profits. So we don't make the typical 1% fee with most of our clients. Most of our clients are paying us just based on results, and that really aligns our interests, we find, with our clients.
That's good. That's good. So how do you keep abreast of market trends, economic developments, geopolitical factors are kind of big today. People are worried about the war in Ukraine, the war in Israel, and the shipping channels and all that. How would that impact your investment philosophies and decisions?
Well, we keep abreast of things like most people do. We just kind of keep our eyes open and our ears open, and we read, and we're aware of what's going on, of course. But remember, we're becoming owners in businesses, and so we're most thinking about, hey, if there's something going on in Ukraine, will that affect anything we're looking to buy or hold, and really take it down to that level, as opposed to, again, the big picture thing, which there's always going to be stuff in the big picture, as you know, Dan, that it's going to provide worry, and you got to get beyond that and recognize when you own stock, you own a business. If you own a good business at a good price, pretty much the big picture is not going to affect you too much.
Yeah, I love quoting Warren all the time, because one of my favorite quotes of him is, when the tide goes out, all ships sink. So it doesn't matter if you're in a good company or bad company. If we're in a downturn, they're probably all going to drop. But can you go ahead?
You can see over my shoulder there, I got a Warren and Charlie little stuffed pillows. They're always watching and making sure I'm doing the right thing.
Yeah, there you go. There you go. Can you discuss any specific investment success stories you've had or notable achievements that Check Capital has attained over the years?
Well, I can't really go into, let's say, the performance, but anyone, again, is welcome to look at our website and take a look at that. But some of the numbers there that we can show you are pretty remarkable. But I just think we just have had, really long-term clients. We have an annual meeting ourselves every year, and it's just great. Like Berkshire Hathaway has their annual meeting, we have our annual meeting. It's just great to see the longevity of our clients. And I think our typical client is on average something like, believe it or not, like 15, 20 years. So it's very rewarding to do, what you do for your business, I'm sure. And what we do is, really help out people so they can have a comfortable retirement and have it financially work out for them.
Yeah, so I mean, and it's true. I mean, I think some of the greatest satisfaction. I think it's a great business to be in myself personally. I love it,
Yeah.
And just seeing people succeed and have that peace of mind and all that. Do you do any investing for any institutions, or is it mainly just individuals?
Very few institutions. We might have a little one here and there. That's usually where we might have the CEO of the company, where you might be investing some of the company money. But our typical client is, a $2 to $3 million net worth. Just kind of your higher middle middle upper class, but really a real common mass affluent, I think, is what some of the financial industry might refer to them as.
Right. So, what advice would Check Capital offer to investors today that are looking to build a diversified and resilient, investment portfolio in today's market environment?
Well, we'll do what it sounds like you'll do too. You'll look at overall the big picture of what the client's coming in with, what their expectations are for their money. Really give them a reality check on whether the expectations, will likely work or not. You can use the rule of thumbs like you kind of suggested earlier too, of maybe spending 4% of your portfolio, and that will usually work over time. Maybe it's a little less now, but we haven't found that to be something that's been that hard to accomplish and make the money last. And really just then a lot of it has to do with educating to make sure clients are comfortable and recognize, the way we invest and are on board with the way we invest. They want to be, part owners of good businesses and can withstand the ups and downs. And so a lot of it's education. We write a monthly newsletter, which is just along those lines of really kind of what's going on. And really it's oftentimes more about what we own as opposed to what's going on in the big picture. We always reference the market. We're always aware of the market, but it really comes down to what you own.
Yeah. How big a shop do you have there? How many employees are at Check Capital?
Yeah, we're pretty small in terms of employees. So with our $1.9 billion, we have just 12 employees.
That's great. So you keep the overhead pretty low for everybody, huh?
Yeah. We look at it all as a win-win here.
That's good. So one I know we're running short on time. We got a couple minutes left, but one of the things that, you never see coming, they call these things black swans, COVID, for example. I mean, maybe we should have seen it coming, but kind of caught us all by surprise. And you never know when these things are going to happen. Lehman Brothers, going out of business. So, do you see any catastrophic black swans on the horizon these days?
Well, they wouldn't be black swans if I could see them. Yeah, no, and I didn't see either one of the ones you just referenced coming, and I won't see the next one coming. I doubt it either. So the good news is we're still here, and our clients are still here, and it's working out financially. So you have to invest, again, with the fact that those kind of things will happen, but you also have to invest with the long-term odds. And looking here, the S&P's gone up 93% of the time over a 5-year period of time. So those are the kind of odds you want to, kind of bet on. 93% odds, you can win a lot of money in Las Vegas with those kind of odds.
Yeah, that's for sure. You never know what's going to happen. That's for sure. And then to throw more stuff on the fire, we got a presidential election this year, and people are often asking, well, who should I bet on? What if Biden wins? What if Trump wins? And either one of them could end up in a heap of trouble. Do you see the election being any type of issue this year?
Well, I think it's another very interesting election, and I do think it'll probably create some market volatility. But if you go back over the history of last 50 or 100 years and look at the, whether it's a Democrat or Republican, et cetera, that's usually not the factor. It's about business. It's about interest rates. It's about inflation. It's about market valuations usually when a president takes over. So that has probably more to do with it than anything else. After the 2008 market decline, the market was set up to do well over the next 8 years, and it
Right.
did.
Right. So I think we're just about out of time. So I want to thank you, Steve, for being on the program today. I think it was a great conversation. And our next guest is Maureen Weigel of General BG. She's going to be on the Money Matters program the next time. And we want to thank everybody for joining us today for another edition of Money Matters. We'll see you next time.